Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen the latest labour market statistics coming out, showing that the unemployment rate is increasing as many had expected, up to 4.3%, previously at 4%. Now, in a sense, yes, the unemployment rate is going up. It's still relatively low compared to, where we've seen it in previous times, but it's very much on the rise now. A lot more labour market slack starting to come forward. You saw not only the unemployment rate increasing, but also the underutilisation rate up to 11.2%. So, it's still going up as well. More people who are out there looking for jobs. Also, though, an interesting increase in the number of the not in labour force group. A lot more people looking like they're going into further study, therefore not looking for jobs as much, given that job ads are low across the economy. One interesting piece that I think we're still trying to get our heads around is how much hiring momentum is there in the economy. The household labour force survey showed a 0.2% reduction in employment over the March quarter. You look at the likes of monthly employment indicators data, though, tax data showing a 0.9% increase over the same period. So a little bit of divergence there, a little bit hard to pick through, but the rest of the numbers sort of start to tell a pretty clear story about that weakness. Also interesting, about half of the weakness or the increased slack in the labour market over the last year coming specifically from young people aged 15 to 24. So there is a unique focus on how those challenges are coming forward. I mean, all of these numbers effectively showed a slightly weaker labour market than the Reserve Bank might have been expecting. In a sense, that sort of shows that although it's obviously awful news for those who have currently lost employment, it's also shown the labour market moving into a position that's more consistent with better inflation.
Yeah, that's right. I mean, like you say, slightly weaker than the Reserve Bank had been picking. I think they had unemployment at 4.2. They had employment growth sort of relatively flat. So both those numbers softer there. So yeah, good news in terms of, I guess, expectations for interest rates over the next 6 to 12 months. Again, it just puts another nail in the coffin of any risks around future interest rate rises. Certainly not enough there, of course, I don't think, to be bringing forward your timing on interest rate cuts, though. So it is still a period where households will be continuing to go through that final phase of adjustment in terms of those higher interest rates and what they're paying for their mortgage. And the Reserve Bank released some numbers around that this week, showing there was increasing stress in the housing market and in the mortgage market for people. But I guess the key for me now over the next 18 months really is just the biggest stresses for households, I think, are going to be coming from further weakness in the labour market. Like you say, probably the only outlier at the moment is employment and whether it's rising or not. Certainly, it's well at odds with those job ads numbers, which are down, I think, 17% from their 2019 average levels now. So there is definite weakness there across those intentions. And I guess the key takeaway around employment is it's definitely not growing as fast as the working age population, with migration having been really, really strong. So yeah, more weakness in store for the labour market. And I think probably that's the key out of that is it is going to be a really strong determinant of economic activity and households' willingness to spend now over the next 12 to 18 months, with more people concerned about their job security and the risks around their income, because businesses are under pressure and there is not a lot of demand out there in the economy. Of course, one of the other factors that comes out of that is what influences that's having on wage inflation. I think we'd seen in the previous quarter signs that private sector wage inflation had been just starting to ease. I mean, what was the latest trend coming through in those numbers this quarter?
Yeah, look, very similar sort of continuation of that moderation. It's still not sort of rapid, but it's enough of a continuation that things are starting to pull back. The public sector wage increases, rather, still pretty high and likely to remain that way for a little bit, given that the numbers are still working through the increases to particularly the likes of health and education pay increases last year. What I found interesting is one of the various measures of labour market wage pressures that we look at, the likes of the unadjusted labour cost index. The quarterly increase for that was the smallest, I think, in about 3 years. So again, not that it's weak, not that wages are falling, just less intense pressure And that makes a lot of sense, right? When you've got unemployment rising, you've got businesses who are saying, look, not as much economic activity coming through the door. I don't need as many additional staff. I'm not hiring as much. I'm also possibly not needing as many staff as I've currently got. Therefore, people are going, well, look, I can't really demand all that much on the wage growth front, because if the business doesn't want to meet that, they'll go and find someone who'll take slightly less of an increase coming forward. So businesses not having to be quite as desperate when it comes to looking for staff. And of course, like you've noted, that's going to take quite a while to fully come through. I mean, the job losses announced in the media and across the public service so far, none of those have actually been counted in the official unemployment rate. They'll take a while to come through. So all of that says that, that less wage pressure coming through, less labour market pressure, generally consistent. I mean, where are we thinking that things go from now in terms of, unemployment at 4.3? That's not the worst, far from the worst we've seen it, even, during COVID and outside of COVID times. Where are we likely to see that sort of number settle at towards the end of this year, I'd expect, or is it going to take even longer?
Yeah, I think, look, the second half of this year, the quarterly rate increase we've seen in the latest data suggests that 5% is on the cards before the end of this year, and possibly pushing up to 5 to 5.5 in the first half of next year. That's probably our expectation for a peak level at this stage. Look, it could be a bit worse. There's a lot of factors feeding into that around, how does the global economy perform, and certainly growth expectations internationally still seem to be capped there, and that's affecting some of our sort of export markets and activity through there as well. How does the housing market, the construction industry perform? There's a fair bit of weakness still hanging around those. And so I guess there is risks that we could see more momentum in job losses. I still don't think it's GFC. And if you go back to the GFC, we had the unemployment rate pushing up to about 6.7, 6.8% at its peak. So we're not talking that sort of increase at this stage. And we have been pretty consistent, I think, in terms of that projection of 5 to 5.5 being the peak expected unemployment rate over the last probably 18 months in terms of our forecasts. So that's our expectation. But like I say, possible risks on the upside. But, we've had one quarter of worse data after a few quarters where we've been surprised at how robust or how resilient the labour market has seemed to be, softening but not softening as quickly as we might have thought. So, yeah, watch the space.
Totally. Well, and that's the thing, right? The labour market is always the last to turn, and it was proving that up until this quarter. It remained fairly stubbornly in a pretty solid position for a lot longer than expected. A bit more coming through in this latest quarter, but also with those job losses starting to come through, with less jobs being offered out there in the economy, there is that general feeling from households that, they can't push it as much. They're worried about job security a bit more. Consumer confidence isn't as upbeat as it was previously. Just those sort of cautious signs continuing to come through in the economy. And of course, like you say, that sort of adds to expectations that we're still on course for interest rate reductions towards the end of this year. But that's because the economy is and will be in that weaker state. We'll assess how all of those different trends come through, how many job losses do emerge, how the unemployment rate shifts, and what that does for the outlook for interest rates on one of our future editions of Econ Talks.